Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist at OptionsPlay. Well, ready to get started here. We got quite a few people logging in. At the moment, as a matter of fact, they're going up by leaps and bounds. Want to let you know that we do take questions. This is a live event. We encourage participation here for this presentation. But if you do want to participate, please do use the Q&A box. The chat box is enabled, but that's really just for the panelists to talk amongst each other. You can talk amongst each other via that chat box, but if you have a question, please make sure you click the little question button, the Q&A box, if you would like. And I'm about ready to get started. Give me a couple of seconds here, and then we'll kick off. I'll let everybody log in. We got hundreds logging in at the second, and then we'll be ready to start. Thanks for coming. All right, everyone, I'm ready to get started. I should be seeing a slide presentation right now, and welcome to the presentation. The title for today's show, or event, I guess, is Learn Call Options 101. We're looking at the money, in the money, and out of the money. So today is actually going to be a combination of the basics with a little bit advanced. I'm going to get into Delta, which is the Greek that actually tracks the pricing of an option contract relative to the stock. And I'm also going to talk a little bit about time decay and about some of those trade-offs between those two particular things in general when you're buying options. But to start with, we're going to just talk about and set up a generic at the money, in the money, and out of the money option contract and go through just the concepts of it, show you a little bit of the OptionsPlay platform. We're going to talk when we start getting into the Greeks and getting into the deltas of the option contracts. And then also I'm going to share with you a daily play that we recently had on a company and talk a little bit about the selection process. Now that's where we're going to get a little bit advanced. There's going to be a couple advanced concepts that are in, but along the way, you can add your questions into the Q&A box. I'll try to address them. I'm on my own today. I don't have anybody really helping me out to go through the questions. So I do really appreciate if you could use the Q&A box, not the chat box, for any questions that you have. Okay, so here we go. Disclaimer, we are going to be showing some actual securities today. They're not meant to be recommendations, and past performance is never a guarantee of future results. It's always important to know. So we thought we'd toss that out there. And here you go. If you want to sign up for OptionsPlay and check out our free trial, please go to optionsplay.com/signup or grab your phone right now, hit that QR code. There will be an opportunity to do that a little bit later on in the show, but I'll show you some of the tools that are inside the OptionsPlay platform that are very important to everybody who likes to trade options. We make it simple for you. That's straightforward. All right. So I'm going to jump right into the four basic positions here. If you're looking at option contracts and you're talking about what an option is. There are 4 things that you can do. We're going to focus on one of them, but it's important to note the other ones because we're going to be talking a little bit about what's the difference between buying a call outright and actually doing a bull call spread. And the difference, first of all, as far as the 4 basic trades are concerned, is that you're dealing with 2 option contracts. If you're just buying a call option, you have a right to buy the underlying stock. And that means that you pay money. For that money, you receive that right. Once you buy that call option, you are considered long that option contract in your account. So I go in, I execute a trade, the trade ends up in my account. I am then considered long that position. Now, I have that right to buy all the way out until that expiration date. And the actual term call option, though, comes from the opposite side. It comes from the seller side of things. If you sell a call option, you take on an obligation, and it's an obligation to sell stock at the strike price at a later date, anytime between now and that expiration date. Once you sell that option contract, you are considered short that option in your account. But another term that is used for the seller of an option contract is a writer of the contract, because back in the day, you actually wrote up the contract and sold it to somebody before options started trading on the exchange. So you were considered the writer of the contract. It comes a lot from the insurance world, where if you buy insurance, you're considered the underwriter of that insurance policy. And if I am the seller of that option contract, somebody can actually make my obligation to sell stock to you at that strike price. But where it really comes from is that, where the term comes from, the term call is from the sell side of things. Because if I am the seller of an option contract, somebody has the right to call stock away from me. So that is actually where it all comes from, and that's the center of most option trading. It comes from the sell side of things. A lot of the vernacular, a lot of the concepts as far as pricing are concerned, and we are going to focus on being a buyer. That buyer receives a right, and what option contract do we want to focus on if we're buying options? All right, so ins and outs for call options. So we're going to talk about in, at, and out of the money option contracts. So I felt the need to define it. This is a very short slide, very straightforward. If you have a stock that's trading at $60 a share, right? Stock's at 60, and you have a strike price of $60. That option contract, it would be considered with the stock at 60 and the strike at 60, and we're talking about a call option. That means that you're at the money. Now, at that point in time, if the stock starts going up and it goes to 65.70, you are then considered in the money. And in the money basically means that if I did exercise that right and I bought that option contract, I would be buying stock via the strike price at 60, and I could sell it higher at 70, 80, or 90, wherever the stock was at. And I would have a real value in that option contract, which is also referred to as intrinsic value. So that's considered in the money. Now, if I had the stock at 60 and the strike was 60 and the stock went down, then it's going to be considered out of the money. In that instance, why would I ever exercise my right and buy the stock at 60 when I could go out on the real marketplace and buy it down here at 50 if the market did go down in that instance? So that option contract is referred to an out of the money option contract. And we're going to go in through 3 scenarios. We're going to buy an at, we're going to buy an out, and then we're going to buy an in. And I'm going to address little nuances inside the pricing of an option contract while we go along with these basic strategies that we're going to look at. Okay, so So if I look at buying an at-the-money call option, so let's start with where we started on our last graphic, talking about at-the-money options. So we got XYZ, which was a fictitious stock, but now it is an actual real stock. Unfortunately, somebody stole that symbol, but XYZ is trading at $60. We're bullish on the stock. We want to have limited risk if the stock decreases in price. That's the general concept of buying a call option. But more importantly, that option contract has 90 days to expiration on this fictitious scenario. We're buying the 60 strike call, which that's where the stock is at. That option contract was trading for $3. That means our cost is going to be 3 times the number of shares that the contract represents, which is usually 100, or it's going to be $300, and you don't want to forget to add in any commissions that you might occur while you're placing the trade. But that really means that our max risk for that option contract is going to be $300. If the stock goes up, that's great, and we make money on the option contract, no worries whatsoever. But if it goes down, the most that we can lose on this position is $300 if we buy one contract, and then we have unlimited profit potential because we have the right to buy the stock at 60. And if we do buy this option contract, though, we want the stock to at least get to 63. So if I'm looking at this and I buy this, you got to think about, well, if I'm going to hold this for that entire 90 days, I have a little something that's called time premium that's in that option contract. And I'm going to move that break-even point. So if I don't think the stock can at least get to 63 over the next 90 days, well, then I want to do something different. I don't want to actually just buy this option outright. But if I look at the profit and loss graph, what does this look like? So to paint a picture of it, we're buying one XYZ 90-day 60 strike call. It's trading for $3. If we just bought the stock outright, we have our x-axis here is the price of the stock, or is the stock price at the expiration date of the option contract, and this is the profit and loss on the position. From 60 on up, we have substantial upside, right, if we just buy the stock outright, but we have unlimited downside all the way down to 0. Stock was at 60, we paid 60 for it, so that's our break even. If we do the call option, we get rid of this, but it comes at a cost. From 60 on down, we can only lose that $3. On the way up, if we hold it all the way to the expiration date, we got to get to at least 63 or beyond. But if we get beyond, we have unlimited upside potential all the way up until that expiration date. So 65, 70, 80, we can participate on the upside. We don't participate on the downside. And because we're altering the risk, we got to pay something up front, and that's that $3 for that option contract. All right, so most popular option contracts are at-the-money option contracts. You get a lot of leverage, you get a lot of bang for your buck, you get a lot of movement if the underlying stock actually moves, and we'll talk a little bit more about that when we get into Delta today. But that's the concept of buying an at-the-money option contract. And if you look at any option chain, you usually see the most volume on that at-the-money option contract. All right, so I want to talk a little bit about closing options, and just about one of the biggest misunderstandings in the options world is that if you're looking at an option contract, a lot of times people will think to themselves, you always need to sell options. 80% of all option contracts expire worthless. Well, if you think about it, it doesn't really make sense. First of all, for every call option, there's a put option. No, not necessarily, but there's a put on the other side of things. And if the call option's in the money, that means that the put option is out of the money. And if the call option's out of the money, well, that means the put option's in the money. So just in general, if you're long a put, if you got just as many puts out there as calls, one of them has to be in the money. And then also just think about your own trading. If you've ever traded option contracts, if you're buying an option, do you usually buy it because you want to own the stock? No, most people buy the option contract because they don't want to pay all the money to buy the stock outright. So what happens? The stock goes up, they sell the option contract. Stock goes down, oh, I'm losing money. They sell the option contract. So most of the time option contracts don't expire worthless. You can always exercise, and that means you'd be buying the stock. So there is some advantage to that. In our situation, we were paying $3. If you were a little nervous, you're like, I want to own the stock, but I'm worried about something, but I don't want to miss out on an opportunity. It's a way to kind of look at an option contract. I was going to buy 100 shares, but instead I buy one option contract. I'm not using the leverage of the option contract to buy as many as I possibly can. And then if the stock does make a move to the upside, I will exercise and I will own the stock. So out of these three things, what do you think is what happens the most often? Number one, and I'll let you put it into, you can put it in the chat box, right? Let's just play with my reindeer games. What do you think happens the most? Number one, sell to close. Number two, exercise. Or number three, let expire. That means it expires worthless and you lost what you paid for it. Or if it is, wow, the numbers are already coming in. Number one, a lot of number ones. Okay, and I do see a couple of number threes. So even though I already started by saying that's one of the biggest misunderstandings, I still got a few people saying number three out there. Not many number twos, right? Not many number twos. Well, here's the numbers. And I used to work for the Chicago Board Option Exchange, which was right across the street from the Options Clearing Corporation. And the Options Clearing Corporation would post this number every year. And it didn't really matter in up years or down years of the market or whatever. These numbers have stayed pretty consistent throughout time. Most of the time, people close their option contract. About 69% of the time, you buy it, it goes up, that's great, sell it and get out. You buy it, it goes down, oh, I don't want to lose everything, you sell it, you get out. That simple. About 70% of the time, people will close their option contracts. Now, about 20%, and we'll call it 19%, I'll use the real numbers, 19% of the time, they let that option expire worthless. Now, you got to realize there are a lot of people out there that want option contracts to expire worthless. Covered call writers, for example, which is probably the most popular option strategy that I've ever noticed, I guess. I know a lot of covered call writers that have never bought an option contract, and they're doing it just to try to bring in income. I know a couple of registered investment advisors that's all they do is sell options on stocks that they own, or sell puts to try to buy stocks if the stock goes lower. So about 20% of the time, 19%, I keep trying to round up, 19% of the time options will expire worthless. And only about 11% of the time do options actually get exercised. And that goes all the way back to what I was mentioning before, that usually if you're buying an option contract, you don't usually want to exercise your option because you paid cash. If the market goes up, you got a marketplace that you can sell it at. Why do I want to put up all the capital to buy the underlying stock, right? It doesn't happen that often. Now, on the put side of things, and we're not going to talk much about puts, but more people are more apt to exercise a put. And the rationale is very straightforward in that if I exercise a call, I spend cash, right? If I exercise a call, I'm spend cash. If I exercise a put, I get cash. So if I own the stock and I just want to get out of the position, I might exercise my put because I get cash now, and I don't spend cash now. And so on the exercise side of things, puts are more likely to be exercised than call options by the owner of the option contract. But these are the numbers. It's been this way for a long, long time. And, year in and year out. Now, I do think it got tweaked a little bit when stock commissions went away, because now you exercise a call option. A lot of times you don't have to pay to buy and sell the stock. So that changes things a little bit. But yeah, these are the numbers, and these have been the numbers for years and years and years. All right. And I pause for a second here before I get into the real examples. Oh, shoot, I ended up, let me exit this for a second because I just realized I just cut and paste something that I didn't want to remove overall. The question, I have one question. Do the attendees get a copy of the recording? The recording is always available. Yes, it's available via the YouTube channel. You can watch it anytime that you'd like. And we will send out an email to everybody that's attended with a copy of the slides. That will also happen in this scenario. All right. I just realized that I made a faux pas right before I kicked off the show. Okay, so buying an out of the money call option. So I have a white paper that I have written that is one of the most popular things out there. And one of the things that it addresses is buying out of the money call options. And so I'm going to give you a scenario of buying an out of the money call option. And we're going to walk through this one. I'm going to spend a little bit of time on out of the money call options. But let's go through the scenario in general. If you're buying an out of the money call option, XYZ stock, it's trading at 60. Forecasts were bullish. We got to be really bullish if we're buying out of the money call option. So we buy one 90-day 65 strike call. We pay $1 for it. Our max risk is $1, and our max profit is unlimited. And our break even now is going to be 60 plus 1 or 61 in this scenario. Or 66, I'm sorry. 65 plus 1 is 66. And if you're buying out of the money options, one of the first things you got to ask yourself is, what do you want that stock? What are you asking that stock to do? And if you think about it, this is a 90-day option contract, and 6 points to get to the break even. That's a 10% move in that underlying stock, which is a solid move if it's just over a year. But in the options world, you have to figure out, well, if I'm doing this, I need to be extremely bullish on this underlying. So if I go and we look at the profit and loss graph of buying an out of the money call option, well, our line moves quite a bit here, right? So stock, unlimited upside, substantial downside. You buy the call option from 60 to 65. You have limited and known downside because you're only buying one option contract. And then you have unlimited upside beyond 66 at the expiration date of the option contract. And here's the biggest thing about buying out of the money call options. The most exciting thing is you buy a lot of them, right? They're not expensive, but they're not expensive for a reason. And I'm going to talk a little bit about that reason, but that's probably the most attractive thing about out of the money call options. And if you're used to buying stocks, I know a lot of people that don't want to buy, I remember when Google and Amazon and all the stocks were $1,000, they didn't want to buy 2 shares of it. And that's the reason why stocks go through splits, so that it makes it easier to buy 100 shares, because that's what people want to do. But then they run to the options marketplace and they're like, oh my gosh, this is $100 for one option contract. In that scenario, you're like, well, I can take all the money that I had to buy the stock and I can buy an option. And that's where my white paper comes in. And I call it one of the biggest mistakes that beginning option traders make is they don't have a realistic expectations about option pricing. So I want to go through a scenario on buying out of the money options, and I'm going to ask you a question. And this is where I actually screwed up my slide a little bit because I did cut and paste this, but here's our situation. Here's my out of the money option quiz. So I want you to play along, take a sip out of your coffee. Here we go. Get ready. XYZ stock, it's trading at $60. We're going to buy one 90-day 65 strike call. It's trading for $1. So here's my scenario. We just bought that option. It's $1. It's got 90 days to expiration. We're going to say that nothing changes except we are right on our forecast. The stock actually goes up to 62, but it takes 45 days to get to 62. So we bought this option contract for $1. It was a 90-day option contract. We are right on our forecast. The stock goes from 60 to 62.50. It goes half the way up towards our strike. It takes 45 days to do it. It's about that is half the time that we have remaining in our strategy, in our long call option. What's the price now? What do you think that would be trading for? All right, so a lot of numbers are coming in. More than one is one. We got one that says 50. We got one that says 150. Less than $1, not 50, 30 cents. I don't see anybody going big on the high side. I see 125 popping in there. I see 2. All right, we got a 2. We got a 3. And I got a good solid answer. It depends on the delta. All right, we'll leave it at that. Well, here's the reason why I like to do a little quiz like this is the last answer that I read, that it depends on the delta. That is a valid point. That will give you some insight as to what the option price should do. But I want to make it simpler than that. And I also put that out there to show that there are hundreds of people on this webinar, and there's a lot of different answers, a ton of different answers. Even though you all are trading in the same marketplace, I assume you're trading in the US and trading option contracts. There's just a lot of different expectations as to what might happen with your option contract after you buy it. And I think we should all be more on the same page. All right, so the answer is, and a lot of people got it right, the answer is that it should be trading for $1. That it should be trading for $1. Now, a key here was that I said nothing else changed. Implied volatility stayed the same. We didn't have any weird things happen to our option contracts. Interest rates didn't change. Everything stayed constant, except the stock went up, and it went half the distance to the strike, and it took half the time to do it. So when I look at this scenario, and I'm talking about my option contract, you have to realize that options have a lot of the pricing of an option contract is to do with probability. What's the probability of the stock reaching the strike by that expiration date? And a lot of people will look at delta, and that's kind of a shortcut to get a good feel for what the option contract might move. But it's really comes down to what are the odds that it's going to get there. And so that's where I started when we looked at our initial setup for the trade, right? I said, well, think about what you're asking the stock to do. You got 90 days. The break even is 66. You're asking that stock to move 10% over 90 days. That's a big movement over a year, and you're asking it to do it over 90 days. All right, so that's part of the reason why I was trading for $1. That simple, that straightforward. Now, if I go and I look at this and I think about probabilities, well, in this scenario, the probabilities didn't change at all. We paid $1 for this option contract, and we needed it to go 5 points to get to the strike in 90 days. All right, that was the based off of the probabilities. They said, well, the marketplace thinks that's worth $1. Well, the probabilities didn't change, right? We got 45 days, we went half the distance, and it took half the time. So the probability of still reaching 65 is about the same. Guess what? The options price is about the same. Now, some people will say a little less than $1, and if you're looking at a theoretical option pricing calculator, it really would be $1. But if you're talking about shorter term option contracts, options would decay at a more accelerating rate. So let's say we started with a 14-day option contract and we cut the time in half and it became a 7-day option contract. That's a little bit different scenario. So I did cherry pick my scenario. Let's put it that way. But yeah, if everything stays the same, the probabilities didn't change. So here's the moral to my story is that if you're a beginning option trader and you're looking to buy options, don't just run to the cheapest option contract because it's cheap. You sound great at the cocktail party. Yeah, I own a whole bunch of these call options. Why? Well, because they're cheap. I can. Why not? Why not buy the cheapest option contract? You got to ask what you need that stock to do to make that option contract profitable and realize that you could buy this contract and be right about the direction and still not make money on your option contract. It's all about the timing. All right. So a lot of people don't look at it this way. Now, I have a presentation that I do called Volatility and Probability, because there's a volatility component of an option contract, and that equates to the probability of that option contract. So you got volatility, you got probability, and those two things don't necessarily, or those two things go hand in hand in determining the price of your option contract. All right, so out of the money options, and we already kind of know this, but I'm going to talk about an in the money option contract. So I want to define time value. And in our option contract, quite simply, we had a 60 strike call. It was trading for $1. The stock was at 55. In this instance, our intrinsic value is 0. We have no real value. Until it gets beyond that strike price, we have no real value in that position. And 1 second, I need to adjust something here. And so if I look at this and I'm thinking about what this option contract was, we intrinsically had 0. We needed the stock to get up to 60 to get to a point where we have intrinsic value. So this option contract was all time value. That's straightforward. Now we're going to go and look at another option contract that has some time value. So in this instance, we're going to keep with the same XYZ scenario. We have the stock trading at 60 or at 65 in this instance, and our strike is still 60. So now we're flipping where the stock is at. So the stock price is at 65, the strike price is at 60. Intrinsic value is $5 in this instance. Why? Because I can exercise my right and buy the stock at 60 and then turn around and sell it in the marketplace at 65. Means I got $5 of real value, and in the options marketplace, we call that the intrinsic value. So now the options price is trading for $6. You subtract out the real value, the intrinsic value, we come up with $1 worth of time value. Okay, so I do want to bring this up. Okay, we're talking about a 90-day option contract, but note, and this is in the theoretical world, and it also applies to the real world. There's a little bit of skew in this, but you know, everything doesn't work out perfectly like it's supposed to in the real world versus the theoretical world. But if I jump back to one slide, notice that this strike with the stock at 55 is 5 points out of the money, and it's trading for $1. Now, if we go to this slide, notice that this option contract, and we'll work through a call example, but this option contract is 5 points in the money and is trading for $6, but also has $1 worth of time value. And this is true of most option contracts, most underlyings that trade options is a better way to say it. Most of the underlyings that trade options. The bulk of the time premium is going to sit on the at-the-money option contract. And we saw that in our scenario. We saw that the at-the-money option contract was trading for $3. That's a lot of juice. That's a lot of time premium. You go further out of the money, it makes sense that time premium goes away, right? You have a much lower probability of the stock getting to that strike. And we saw that that option contract was trading for $1. But now when we go in the money, it's a little bit less intuitive as to how much time premium there should be in your option contract. But bluntly, usually if you're 5 points in the money, it will have about the same amount of time value as being 5 points out of the money, right? So 5 points in, if you center it right around the at-the-money option contract versus 5 points out, you usually are buying the same amount of time premium. The option act reacts much differently, but the time value is the same. And it's a fairly important concept when you start getting into the next level of trading, when you start looking at spreads, knowing how much time premium you're buying versus how much time premium you're selling. That greatly affects your break even across the board. But I just wanted to take that opportunity to point that out, because a lot of people don't think about where does that time value come from when you're buying an in-the-money option contract. So with that said, let's get through the scenario. Here's our situation. Stock's trading at 60. Bullish on the stock, want limited risk. We buy one 90-day 55 strike call option, and we pay $6.30 for that. The cost is, in this scenario, $630 times 100, or $630. The max risk is $630. We have unlimited profit potential. Break even here would be 61.30, which is the strike price, which is 55, plus the premium paid $6.30, or 61.30 on our option contract. All right. So here's the difference in the break even. Buying an at-the-money option contract, if we buy this at $6.30, our break even only moves up to 61.30. Notice that this is a very small black line in between where the stock is at and that break even, and the break even of the in-the-money option contract. So if I'm thinking about all three of these things, and the probability example that I talked about on out-of-the-money options, well, that doesn't really apply here, right? Because we're already in the money. So now you just need to know how much will my option contract move relative to the stock price movement. Because I have real value in my option now. And if it's intrinsically worth something, you're going to be able to sell the option contract for that, right? If it's intrinsically worth 5, it's got to trade for 5. If it's intrinsically worth 6, it's got to trade for 6. And then any other time premium above and beyond. So, moral of my story, if I buy this option contract, or if I'm bullish on XYZ stock, and I think the stock's only going to move a few points, this is the option contract that I want to buy, as opposed to my out-of-the-money option contract. And then you can say, well, maybe I want an an at-the-money option contract. And that's where a lot of people fail. Like if you look at volume, and you look at open interest, which is something that goes hand in hand with volume in the options marketplace, you will see the bulk of it is usually where the underlying stock is and all those strikes that trade within that specific expiration. That is the most leveraged option contract. You get decent movement because you're starting at the money, but you're also paying up for it because it is one of the more popular scenarios. So you have 3 scenarios. You have an at-the-money option contract, which is one of the most popular trades to do. And then you have an out-of-the-money option contract, which is the most speculative. If you're going to be right on your forecast and you're going to get the movement that you need, the best option contract to buy is the out-of-the-money options. Because I've done seminars like this before and everybody says, oh, you're telling me to never buy out-of-the-money option contracts. I'm not saying that. You just need to have a realistic expectation. You saw how many people in the chat had a different expectation as to what was going to happen when the stock moved half the distance in half the time. It was all across the board. Now, in this scenario, if the stock goes up, and I said it went up 2.5 points, guess what? I'd expect to get close to the 2.5 points. Why? Because we're in the money already. We're already there. Now the only component is that little bit of time premium that's in the option contract. And that's it. And that's the only thing that we have to guess on as to where that would be. Intrinsic value is intrinsic value, and we have to get that if we ride it all the way to that expiration date. All right, let me address a couple of questions, and then we're going to get into time decay, and we're going to talk about delta. So if I go and I look at this position, well, we got some questions. Now, if you have questions, and I know a lot of people have just recently logged in, but if you have questions about this, try to put them in the Q&A box, and I'll try to address most of the questions in the Q&A box as opposed to the chat box. Okay, we'll be below 1, depends on under, okay, that's where we're at. If you're doing any of these trades, the equity requirement, Get into an option contract, if you're just buying options, is going to be the premium, Robert. So it's very straightforward. If I pay $6.30 for my option contract, that's $630. And that's what I'm going to have to pay for that option contract. And that's going to be my max risk, and I'm going to have unlimited upside potential. Now, on this side of the coin, could you be assigned on the short leg of a long call vertical spread? If the stock price moves significantly, if you call goes deep in it, is there a risk of early assignment? Okay, so we talked a lot about this one, Mo. Mo has a great question, but it does a little bit on assignment. And so this goes from when we were talking about it. Is there a risk of being assigned if you sell an option contract? The answer is yes. You're dealing with real people. If somebody wants to exercise an option contract just because they're mad that they lost money on it or something, I mean, you're dealing with a human being. They can do it. They can exercise at any point in time. When you sell that option contract, you take on that obligation. You get cash now and you take on an obligation. So will you be assigned? Most of the times, no, unless it ends up getting in the money. But could you be assigned early? Say it got in the money early. The odds are, yeah, you could be assigned at any point in time during the life of the option contract, but I showed you the numbers, and the numbers still hold true across the board. All right, and you usually get assigned closer to expiration, mainly just because of what I said. If you exercise an option contract, you spend cash now. Why would you spend cash now when you could spend cash later? So most of the people will wait and spend cash later. And then the only other exception is on the put side of things. If I exercise now, I get cash now. So some people want the cash now as opposed to the cash later. So you're more likely to be assigned early on a put than you are on a call. All right, we'll keep going. Okay, so I got a couple of questions about timing and stuff like that. And that's going to be addressed here in the slide presentation. So let's start by looking at time decay. If you have an at-the-money option contract and you have 90 days remaining to that expiration date of that option contract, here's the way time decay moves. Now, is everybody sitting down? You guys ready for this? Right? Options move at the square root of time. I know it's an exciting concept you might want to run out and tell all your friends and family about, but it actually works. If you look at a Black-Scholes pricing model or any other pricing models, you'll see a lot of square root signs in there. And it's one of the theoretical things that actually kind of holds true. So if I'm buying an option contract and it decays at the square root of time, what we end up seeing is that as expiration approaches, and this is part of the reason, like I said, with our 60-day option contract, or our 90-day, and it goes down to a 45-day, the rate of decay is almost 1-to-1, right? Each day that goes by, we have a similar amount of decay all the way down to the 45-day range. But then from 45 days down to 30 days, the line becomes a little bit more slanted. And then from 30 days all the way down to 0 days, it's like, wham, my sled hit the tree, right? So you have a linear rate of decay to start with, and then as you go further and further, and as expiration approaches, time decay becomes greater and greater. Now, that makes an argument that if you're going to buy out-of-the-money option contracts, you might want to buy something that has a lower rate of time decay. So you want to go by buying more time then as opposed to less time because of the rate of time decay. But guess what? Time is money. So the more time you buy, the more costly that option contract is, which also means you're going to have more risk if your forecast is incorrect. But as far as time decay is concerned, this option contract going, if you're thinking about 30 days to be in your option contract, I'd rather be in a 90-day that goes to a 60-day than in a 30-day that goes to a 0-day, right? So 0-day option contracts, they're very attractive, 0 DTE in this day and age, but there are trade-offs to those option contracts, and time decay and the rate of time decay accelerates as the option gets closer and closer to the expiration date, and that is just something to be aware of. Now, other things that you need to think about if you're thinking about buying options, buying out of the money, buying in the money, buying at the money options, is how your stock moves relative to how your stock moves as it goes in and out of the money. And there's a little pricing component that somebody's already brought up and talked about called delta. So let's get into delta. And delta actually goes hand in hand with time value. Time decay affects the delta of an option contract immensely. And so I'm going to try to prove you that point. So keep that thought in your head as I go through these slides on delta. Okay. Delta is the amount the theoretical options price will change for a corresponding 1 unit or 1 point change in the price of the underlying stock. So the normal unit is a point. And if you have a scenario where we were talking about the stock being at 60 and you're buying the 65 strike option contract, somebody said, well, if I knew the delta, I would know how much my option should have moved. Well, let's look at a scenario where we just got a at the money option contract. So the stock is 50, strike is 50. At that moment, our delta is going to be close to 50. And I'll explain why. But if the stock goes from 50 to 51, and we had a 2-month call option that was trading for $3, we would expect our option contract to go from 3 to 350. Why? The delta says it so. And it would be a little bit more than 50 cents because it's dynamic. It's going to move along the way. But in a theoretical world, for now, we're going to say that it moves exactly what the delta said it would. And then if the stock goes from 51 to 52, now here's something that's interesting, is it goes up more than 50. In this scenario, it goes up 60 cents. So first point movement, we went up 50 cents. Second point movement, we went up 60 cents. And delta increases as you get deeper and deeper in the money. Time value comes away, becomes more intrinsic value, and you get more stock price movement, more stock price representation. So I'm going to give you a non-textbook definition of delta that will help you get a feel for what delta should be and help you understand why an at-the-money option contract has a delta that's close to 50. All right? And this also goes hand in hand with time value, how time value affects your delta. Okay, so now this is the advanced portion of the seminar, right? I'm going to try to make things and say it in as layman of a way as possible. So if you're a beginning option trader, don't let this scare you. But delta is an important concept, and if you're considering buying in, at, or out of the money option contracts, you need to know this concept. Okay, so delta is the probability of the option being in the money on expiration. Say it once again slower. Delta is the probability of your option being in the money on expiration. All right, stock is 50, strike is 50. What's the probability of the option being in the money when the stock is 50 and the strike is 50? It's 50-50, right? If it ticks up, it's in. If it ticks down, it's out. So to start with, most at-the-money option contracts, doesn't even matter what the underlying stock is, will have a delta fairly close to 50. Now, there's some real-world things that can kind of mess with that a little bit, but you need to know the theory before you can kind of apply it to what's going on in the real world. But if the stock is 50, the strike is 50, the probability of it finishing at least 1 cent in the money on expiration is 50-50. Now, the stock goes from 50 to 51. Boom, that was a big move. In that instance, now what's the delta? Well, if you think of probability, I know the probability is higher than it just was, right? So guess what? The delta will reflect that. So in the first point movement, we got a 50-cent movement. In the next point movement, we actually got a 60-cent movement, which meant delta went to 60. The probability increased and the delta reflected that. Now it goes from 51 to 52 in this scenario. Well, the delta is even going to be higher. Why? Higher probability of it finishing at least 1 cent in the money on expiration. And if it goes out of the money, what's going to happen to delta? The exact same scenario. As you get further and further out of the money, the probability of it getting in the money is going to go down, and delta is going to go down accordingly. So I don't have an example of the stock going down, but in this scenario, if the stock is at 50, it goes down to 49. Our $3 call option, you would expect to be trading for $2.50, right? You would have lost 50 cents on that movement to the downside. And then if it goes down another point, well, then you should lose 60 cents on that next point movement, because that, or you would lose less, you'd lose 40 cents on the next point movement. Why? Because the probabilities are changing that the stock can get up to that strike, and delta is going to reflect less probability of that happening the further you get out of the money on that position. All right, that was a big slide. So let me see if I got any other questions on that. Okay, Robert asks a little bit about how to decide when to close early, whether winning or losing. That's a loaded question. A lot of times you might want to do it based off of what your concepts are on the stock. But there are some simple things. You can say that if the underlying stock is, if I double, I want to get out. If I'm down 50% on the downside, I want to get out. So I'm going to try to manage my risk reward, and that on the upside, I'm not going to necessarily think I need to hit a home run and knock it out of the park. But on the downside, I'm going to manage the risk, and I'm going to try to only lose half of what I paid. So if I had a $3 at the money option contract, I'm going to get out at $1.50 and I'm going to sell at $6. Like that. That's simple. That's straightforward. All right. But there's no golden book of answers to that one about the closing early and all that other stuff. All right, and so if I'm looking at this, at some of these questions, so if I'm buying options and I have an outlook for the underlying stock, there will be, I'm going to go through a scenario that we recently did inside the Daily Play, which is part of the membership emails that we put out for everybody that's an OptionsPlay member. And I'm going to talk about a scenario where I'm trying to get things on my side if I'm buying option contracts. And we're going to walk through that scenario, Robert. So I'll talk a little bit about that. But setting parameters is important. Saying, coming up with the numbers that make you feel comfortable. The general rule with a lot of people that are buying options, if I double, I get out. If I lose half of it, I get out on the downside. But the biggest thing about it is there's so many people that will trade options and buy long-term option contracts or out-of-the-money option contracts, and they just don't stick to the plan. So if you have a plan, you want to try to stick to it. And that's the hardest thing, especially when you're just buying option contracts outright. Don't at-the-money option contracts have the highest gamma? Okay, William, you're introducing a new term, gamma. But yeah, they do, because if you think about an option contract, what you're talking about is the movement of the delta. If the delta is 50, what's the biggest delta can get to? That's actually a good question. If the stock is 50 and the strike is 50 and we got a delta of 50, what's the biggest the delta can get to? 1. Delta can't go beyond 1. So I used to ask a question sometimes like that scenario about buying the out-of-the-money option contracts, but a lot of people will say, well, if I buy an option contract and the stock moves in my direction, I will expect that option contract to move 2 points as opposed to 1 point. And the answer is no, it can't. It's a derivative. It's derived from the price of an underlying. So when that scenario happens, you're never going to get more than what you would have gotten if you bought that underlying. Sometimes it might feel that way in the options trading world, but just by definition, a derivative of that, of something else that it's derived from, you don't get more than if you bought the underlying stock outright. All right. So if I'm at the money, yeah, I'm going to have the most gamma. Why? Because delta could go to 1. You got 50 cents on the upside. And on the downside, it can only go to 0. So at the money option contracts usually have the most explosive option contracts in that they have a lot of gamma because delta can move the furthest when it's at 50, when you consider the limitations are 1 on the upside and 0 on the downside. It's the most explosive option contract, and that's what gamma is all about. Charles, I don't think I'm going to really get in. Charles is asking about exercise and an example of it. It's really not an example. If you call up your broker and say, I want to exercise and buy the stock at 50 in this scenario, that's what you do. But a lot of times exercising you can't do online. You actually have to call in to do it. Very few brokers allow you to exercise online. So maybe that's a good answer for your question, Charles. You got to call. Some brokerage firms give you that, have a button that you can click, but very few do. Alex, mainly because it doesn't happen that often. Like I said, 10 or 11% was my number of people that exercise options, and it doesn't happen that often. So there's no real demand to be able to click a button and exercise an option contract that has days remaining to expiration. Alexander, what do you say about deep into money options? All right, Alexander, if we're going to go deep into money, that's a surrogate for owning the stock. And my book, the Options Playbook, if you go and check it out, there is a section about buying leap options as a surrogate to buying stocks. And leaps just stands for longer term options. That's a marketing term that the Chicago Board Option Exchange put together, but they're option contracts that go out 90 days or beyond. And I don't mind that. It's an interesting alternative to buying the stock outright. But my concept, if I'm buying those deep in the money option contracts as a surrogate for owning the stock, I don't want to over leverage myself. If I'm buying that option contract and I was normally going to buy 100 shares of stock, I'm going to buy one option, maybe two, as an alternative. I just don't want to use all the leverage because that defeats the purpose of buying a deep in the money option. You're buying that because you don't want all the risk of owning the stock, but you want something that acts like the stock. And that's would be my explanation of buying deep in the money options and what things you want to consider. But inside the options playbook in the basic section, talk in detail about buying leap options. It's optionsplaybook.com, optionsplaybook.com, if you want to read a little bit more about it. Well, somebody said, how do you remember all this information? I don't know. You trade options for a long time. I've been doing this for 20 plus years. Can you talk a bit about volatility and probability and volatility crushing it? Stephen, I think that's a little bit beyond volatility and probability. They go hand in hand, but how it might move around in earnings or what can happen to volatility, that's a different beast for a different day. Robert actually goes back to the other thing. If you have a preconceived exit plan, you might want to just consider a spread. And there's a lot of truth to that. There's going to be times when buying an option contract makes sense, and there's no golden book of answers as to you should always buy options, you should always do a spread, you should always sell a spread, you should always do an iron condor. And that's my book. I have 40 different plays in it, and part of a lot of seminars that I do are trying to look at scenarios where this strategy makes more sense than that strategy overall. Okay, and Ted asks about buying an index versus a stock, buying an option contract that trades on an index versus a stock. There's not much difference between the two. Delta still the same, time value still decays at the same rate. One of the biggest things about indexes is there's usually not as much time value, i.e. volatility value, because indexes just don't move as fast as stocks do. Particularly to the downside, right? Because you have a basket of stocks. If one goes up, one might go down, and it kind of offsets each other. So one of the things I do like about index options, and I trade a lot of index. I like the S&P 500 index. I'd rather trade the SPX than the SPY. And the big reason why is that they're cash settled. If you have a fancy position on a butterfly, or if you are buying a call option and you want to ride it all the way to expiration and it's in the money, all that happens is cash goes into your account as opposed to stock, right? So the index, and they're called cash settled indexes, and it makes things a lot simpler. As a matter of fact, I know from working at the Chicago Board Option Exchange and being part of many brokerage firms throughout the year, used to be on the retail markets committee for the Chicago Board Option Exchange. They've thought about doing cash settled stock options, and I would love to see that. You don't have to get blindsided by early assignment, exercise, all that other stuff. And if they had the demand out there, the thing is, if you keep adding more and more products, bid-ask spreads widen because there's just not enough volume to support all the products. But yeah, that's been a discussion before, and that's one of the things that I like. So just in particular, one of the reasons why I would like to trade, or I personally like to trade the SPX, the S&P 500 index, and options on the SPX, as opposed to options on the SPY. And it's all about the cash settled indexes, and there are some tax advantages that I don't want to get into at this point in time of trading the index options. All right. So here's delta, and here is probabilities. So I introduced this concept. So this is the concept that we're going to focus on. And I'm going to tie in, well, let me go back. I'm trying to point to it, and I keep trying to highlight it, but I just want to point to it. The delta is the probability of the option being in the money on expiration. Okay, so I talked about an at-the-money option contract having a 50-50 delta, have a 50-50 chance of being in the money. So the delta is close to 50. Now, I told you, as far as time decay is concerned, if you're buying an out-of-the-money option and the stock's not going to go anywhere, you'd rather buy a 90-day option than a 30-day option, right? 30 days go away. On a 30-day option, time decay is immense. It's very, very fast moving. You buy a longer term option contract, you go from 90 to 60 days, time decay isn't that bad, but you had to pay for it. You had to pay for that option contract. All right, now here's another trade-off to time decay. And here's a benefit of buying a shorter term option as opposed to a longer term option. So I'm going to say that again. Delta can be a benefit of buying a shorter term option as opposed to a longer term option. So let's change this scenario around. Let's not make this a 2-month option contract. Let's make it a 1-day option contract. Stock is 50, strike is 50, 1 day remaining to expiration. Stock is 50, strike is 50, 1 day remaining to expiration. What's the delta? Put a number in your head. Stock is 50, strike is 50, 1 day remaining to expiration. It's 50. You can't get more 50-50 than that. You got 1 day, if it makes one little tick to the upside, it's in. It makes one little tick to the downside, 1 cent, it's out. You have a very 50-50 chance of being in the money on expiration. But where does it change? When the stock goes to 51 with 1 day remaining to expiration, let's say, boom, it makes a big jump. Now it's at 51. What just happened to our delta? It just exploded, right? Because if you think about this non-textbook definition, that delta is the probability of the option being in the money. When it goes from 50 to 51, now that probability is large. I got about a 90% chance that underlying stock is going to be at least 1 cent in the money when the stock's at 51 with only 1 day remaining to expiration. So the concept would be, stock's at 50, strike is 50, the market opens, boom, it opens at 51. All of a sudden, the delta of my option contract was at 50 and it went to 90. Goes up again, now we're at 1. We have an option contract that acts like the underlying stock. Every time the stock goes up 1, the option contract goes up 1. and that will happen. So if I'm going to be right on my forecast, right, and I'm thinking about buying at the money option contracts, I would rather buy a shorter term option contract than a longer term one, because Delta will reward me quicker on the short term option contracts as opposed to the long term option contracts. If I'm going to be wrong, I would rather have a longer term at the money option contract, because time value will decay at a slower rate and give me a chance to get back, or I won't lose as much if I'm wrong on my forecast and I sell it and get out. So to prove that concept, this little table that I've used for many years was real call deltas from a particular stock that was trading around $100, and that's all that I was looking for. And if you see here, the stock's at 103, and here's the difference between an 8-day and a 42-day as far as delta is concerned. The price is obviously going to be different. Time is money. But if I buy the 100 strike option contract with 8 days remaining, that's we'll call it $3 and change, but 3 points in the money. Well, my delta's 76 there. I'm 3 points in the money, 8 days remaining. I got a real option contract. Stock goes up 1, my option price should go up 76 cents, meaning that if I own one option contract, I should make $76. That's a real movement in my option contract. Now, if I go to the 42-day, well, I still got a good delta. I'm still in the money. My delta is still above 50, but it's 12 less than my 8-day option contract. So once again, if I were going to buy an option contract and I knew I was going to be right, I would rather own the 100 strike call than the April 100 strike call than the May 100 strike call, right? Just that simple. I'd rather own the 8-day option than the 42-day. If the stock starts moving, I am going to get rewarded quicker. Guess what happens? If we go out of the money, the exact opposite is true, right? So now with the stock at around 103, the 105 is a couple of bucks out of the money. Well, with 8 days remaining, my delta's smaller. It's 37 as opposed to the same strike on the 42-day, it's 46. Why? Well, now I have a higher probability on the longer term option contract that the stock might move up and actually finish 1 cent in the money. So delta definitely changes as expiration approaches. So where is the happy medium? And that's always the debate. Should I buy, if I'm buying out of the money option contracts, I should always buy longer term options, right? Because of the way that time decays. If I do that, I also get I get more delta on my option contract, and I could get rewarded quicker if that underlying moves. But as expiration approaches, the script will switch in that if my option contract gets in the money, then I want to be in the shorter term option contract because I get rewarded quicker in that instance. I pick up more delta. So there's no golden book of answers. You just need to understand these concepts when you're buying option contracts and realize that this is a real thing. So if you flip this script and you're not talking about buying option contracts, think about selling option contracts. Let's look at the 105. I can sell this 8-day and get $1.15, but if I sell the 42-day, I get $3.60. Wow, that's amazing. But in this instance, I get a huge rate of time decay, but if it gets in the money, stock moves $2 and all of a sudden it's in the money, that delta's really gonna hurt, right? Shorter term options, if they get in the money and you're the seller of an option contract, they will move against you a lot quicker. If you're the buyer, that's a good thing. If you're a seller, that's a bad thing. So I've known, but back in the day, they used to call that last week to expiration because somebody brought it up. They brought up the concept of gamma. They'd call it gamma week because in that last week to expiration, you get a huge rate of time decay, but man, if it sneaks up on you and gets in the money and you are short that option contract without any protection, it's going to hurt, and it will hurt you for every single point that the underlying stock moves. Eventually the delta will get to 1 quickly, and it will go against you quickly. That's straightforward. All right, so that's the end of my PowerPoint. I'll put up my book here in a second because I see a couple people talk about that. But more importantly, check out OptionsPlay. I'm gonna walk through one scenario that I'm gonna talk about. Just a little thing that I have always used, more advanced strategies, but it can also apply to just buying call options outright. And I just recently did it in a daily play using Newmont mining, and I want to talk a little bit about the concept of that and go through it. So if you are a member and you know what I'm talking about, you might want to stick around and listen to it. All right, John, as a seller, you want a lower delta. As a seller, yes, John, I want a lower delta if I sell. And I just need to realize that if I'm selling and this market goes against me, and in particular, it goes against me as expiration approaches, delta will harm me when it gets in the money. It will explode to the upside, like my scenario about 1 day remaining to expiration. Can you imagine? A lot of people like to sell 0 DTE options, right? They want to sell that and they want it to decay. Well, let's say it doesn't. Let's say it actually moves and gets in the money. It's going to hurt. It's going to hurt a lot. Delta's going to get to 1 very quickly, and every single point that it goes against you, well, it's in the money, it's going to move 1 against you. Not 50 cents, not 40 cents, not 30 cents. It's going to start moving 1 to 1 against you on those shorter term option contracts. All right. Take out your phone, snap a picture, or go to optionsplay.com/sign-up and sign up for the free trial. Check it out. My name's Brian Overby. You can follow me on X. My handle is @BrianOverby. OptionsPlay website is optionsplay.com, and my book is actually optionsplaybook.com. There is a link in there. If you click on it, it will take you to a place that you can buy it if you want. Somebody asked about it. But I say this, and this is one of the things. The playbook does very well as far as sales are concerned, but I've always been confused by it because all the content is actually on optionsplaybook.com. It's not in a nice little format, right? But I don't make you build a sign-on or do anything to get the content. It's all available for free on optionsplaybook.com. Okay. I'm going to back out. And I'm going to bring up, okay, so I'm sharing with you basically my write-up for Newmont Mining. Newmont Corporation is actually the better name, and NEM. And recently we talked about, Tony did some research, said he'd like to, mainly because of gold, and somebody brought up gold, that this is an alternative. If you like gold, this is a mining company that can benefit from mining gold and a lot more than just gold, but a lot of other minerals. And in here it says, be aware that the earnings date is on February 20th. Now I put this together and the rationale was it was on February 6th, okay? So February 6th, we bought one, in the write-up, bought one Newmont Mining February 28th expiration, 42 strike call, and it was trading for $3.85 or $385 for one contract. Now this is an advanced concept, okay? But I know that it's going to be announcing earnings on February 20th. What will normally happen to an option contract as the known event, the big event is coming your way, that earnings event, right? Implied volatility usually increases. So in this instance, I'm buying this call option. Should I buy an expiration that expires before the earnings, or should I buy an expiration that expires after the earnings? Now, in this instance, it was on the 6th, the earnings, so you had 14 days before that earnings event, and the entire life of the option contract was 22 days long. Obviously, I think that you should buy one that expires afterwards, and here's the reason why. It gives you an option that if you want to ride it through earnings, you can. You do have to pay more up front because you got to pay for that higher implied volatility. But the anticipation is that it's even going to go higher, right? So I'm buying this option contract. I have a bullish forecast. I want the underlying to go up. I got to pay a little bit more right now for that option than I did if I bought one that didn't expire after their earnings because of that known event. But I anticipate that implied volatility is going to continue to go up. My whole plan here was to try to sell the option contract before that expiration date. Did get a movement to the upside, got an increase in implied volatility, closed out the trade. Now, somebody asked me about that, about implied volatility and trading around. But the concept here is that I pretty much, in 99% of the cases, implied volatility will increase as expiration approaches. If I'm long an option contract, I want implied volatility to increase. And so in that scenario, if I'm looking at this trade, that is the way that I set up the trade. Now, stock made a small move to the upside. The option contract almost doubled, not quite. And then I had a decision because I could also roll into a long call spread. I could sell a call option with this same expiration date, but with a different strike, higher than where the underlying was at. So in this instance, we were buying a little bit in the money option. Stock was at 44, bought the 42 strike call option. Had a little bit in the money, so we got a little bit of intrinsic value, got a little bit of time value. The time value was increasing a little bit as implied volatility started to increase going into earnings. Did get to the move to the upside, so decided I'm going to sell, not take the risk of the earnings, get the benefit of the increase of the stock going up. Delta was probably 60 on this option contract when it was put on. Implied volatility increased, gave a little bit more bump to the delta on the upside, and then sold it and got out of the position before the earnings announcement, which has actually just happened right now. Might have been a bad move, I don't know. I think the earnings is actually right at this moment. They probably already announced. Now, that also means that if I was down on the position and I wanted to, I don't want the cheese anymore, just let me out of the trap. I could roll it into a long call spread. I could own that option contract and sell an option contract to the upside, sell that pumped up implied volatility to go along with the option that I own, and hope that the news is good and that it still goes to the upside. So there's no golden book of answers. You got to look at the scenario for your outlook for the stock, what's going on in the real market. But one of the things that the OptionsPlay platform always highlights is when the next earnings is, because it's very important to know that date. So NEM, I don't think this is going to show me after hours, but it's showing you here that it's on February 20th, and this is it's after the market. It says PM on Newmont Mining. All right, so also let me go in and let me highlight a couple other things. If you're buying an option and we hit modify, right? We're looking at these things, and we're going to just look really quick at deltas. This option contract on Newmont is going to have a lot of premium in it. Actually, let's go back to Apple. That's what I was going to use, mainly because it's already announced earnings, so there's not this weird thing in implied volatility. Buying a call, it's recommending buying this call option, the April 17th if you're bullish on Apple. But if I just look at the deltas, okay, 56 days remaining, and I click on these strikes, the most at-the-money option contract, right, the 245, has a delta of 56, which is the days remaining too, but 56. I go a little bit deeper in the money, it's 65. I go down to 235, it's 73. Go down to here to 230, it's 79. So let's focus on the 235 strike, right? 235 strike has a delta of 73. Let's go and make this a 1-week option contract, or something close to that. So we're going to scroll up and we'll do the February 8th. And let's once again look at that same strike, 235, 89, right? So what I'm showing you is that the delta in this scenario is much higher on the 8-day option contract than on the 56-day option contract. And then we can go back the other way. So 235 strike, 89 delta. Let's go out of the money. Let's go up. Let's see this the 250 stock is at 245. So the 250 is trading for a 29 delta. This is the delta right here, 29, with 55 days remaining. So let's see if you've listened. What will happen? Will the delta go up, go down, or stay the same when we look at the 55-day option contract? Will it go up? You don't have to answer, but I want you to think about it before I go out and answer it. I see I got a little hair issue going on here. But if that is the case, will it go up? Will it go down? We're out of the money. What's the probability of it getting in the money? Probability is pretty low right there, right? You got 8 days remaining and it needs to move 5 points. Fairly low probability considering you'd have 56 days remaining and it only needed to move 5 points. Probability increases, right? So delta is going to get higher. So it's at 30 now. Let's go back to that same scenario. Go out to, we said, 56 days. Click this little button and look at the 50 strike delta now is 47. So it went from 29 to 47 on our 50 strike call option. So there you go. That's in the real world showing you what we just showed in the theoretical world via the PowerPoint slides. All right, I'll answer a few questions. I'm getting a little bit long-winded at this point in time. We're already over, but I'll address a few of the questions. Let me go back to the slide. I'll put this up. I'll put this one up so that you can check out the free trial for OptionsPlay while we answer a few of the questions. You might have said it, but I missed it in your talk. What happens if I buy a call and it expires? Well, if I buy a call and it expires in the money, I would end up owning stock, Anonymous. I'd end up owning stock. And you got to be cognizant of that. There is an issue. If you don't have the capital in your account to buy the stock, well, the brokerage firm might have to make a decision for you. They'll try to get a hold of you. But if I buy a call option and the market goes up and becomes in the money, I have the right to buy the stock at a lower price. That behooves you to do it. And so most people are going to just close it out in the marketplace and not exercise and buy the stock. But note that that is a real risk in the marketplace. You want to know, so if it's out of the money and it expires, then you get nothing. So you paid, let's say, $2 for it, and the stock didn't finish in the money, then the option's going to expire worthless. And one thing that can help you out here, Anonymous, with your question is think of options as what they are. They're a contract. And if you think there's a lot of underpinnings from the insurance world that goes into the options marketplace. And it's the same type of thing. If you bought car insurance and you never crashed your car, 6 months goes away and that option contract is worthless now. Why? You paid for it up front. You paid a premium. You never crashed into a tree. So that obligation was never out there for State Farm to have to give you a new car. The option contract expires worthless. And then you got to buy another 6-month policy. And that's the concept in the options world. It comes from the seller of the contract, of the writer of the contract. And it is a negotiated contract from beginning to end. Aren't spreads always less risky than calls? William, once again, there's no golden book of answers. If I do a spread, a long call spread, and I pay more for the long call spread than I do for the call, well, there's more risk in the long call spread, right? Because I paid more. I have more risk because I put up more capital. Now, if you talk about the dynamics of the pricing and you're talking about time decay, well, if you do a long call spread, you're buying an option contract that doesn't want time decay, and you're selling an option contract that wants time decay. So the dynamics of the trade are much different, but the overall risk comes from the total cost that you're doing. So it's a much different trade to do a long call spread as opposed to a long call. All right. Yeah, the amount Mark said it well. The amount risked is the amount risked. Spreads lower the cost basis. Well, it can It can. It really is all about how you set up your spread. So let me go in and look at this scenario. Okay, let's just put this one to bed, and then we'll finish with that. That'll be it. So if I look at this call, and we're in Apple, and we're just going to buy a call, we'll buy something that's, we'll buy the 250, and we'll do something that's 15 days out. All right, that call is trading for $2.50, right? Well, if I buy a spread and I pay more than that for the spread, and so let's modify, let's add a call, and let's go down and let's buy the 245 and sell the I got to make this right. 250, we'll do the 255, okay? And we trade that. That's trading for $5.80, right? I'm paying more for the spread. Oh, that's not right. I didn't hit sell. $3.80. I'm still paying more for the spread than I am if I bought the call outright. That's all that the point is being made. The spread reduces the risk. Instead of having $4.80 of risk, I sell the call. I lower my risk to $3.80. So that's a true fact. But it's just all about the dynamics on how you set it up. I don't know. I don't think you can get access to the chat. But you can watch the presentation again on the YouTube channel. There will be an email that will go out with the slides and a link to the channel, okay? So you will get access to it. That will be there. All right, everyone, I'm going to let it go. We're moving on beyond buying calls. We're getting into spreads and covered calls. We'll move on. We'll have every Thursday. We're going to have webinars going forward. If you have topics, send them to support@optionsplay.com. Things that you'd like to see. We'll see if we can try to address them. Thank you so much for your time. Please check out Options Play. As I said, here's my name and my ugly mug. Brian Overby @BrianOverby on X.com. If you want to know what I'm doing, OptionsPlay.com and OptionsPlaybook.com. Check them both out. Thanks for coming, everyone.